In today's video, we're taking a look at an important and likely overlooked risk in your portfolio, guys. Have you ever considered the risks associated with overconcentration in a few key stocks? With the markets near all-time highs and focus on the Magnificent Seven, your holdings may actually be skewed more than you realize to these stocks. If your portfolio were a party, would it be a diverse gathering of unique perspectives or a fan club meeting for the Magnificent Seven: Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and Tesla? These tech titans have been the belle of the ball in 2023, driving major gains for many investors. But as with any party, it's risky to focus all your attention on just a few guests. Overconcentration in these stocks can leave your portfolio vulnerable. If these companies falter, your financial health could take a hit. Diversification, therefore, is not just a buzzword. It's a strategy for resilience, helping to spread risk and potentially smooth out the bumps in the road. A balanced portfolio is not just a nice-to-have, it's a necessity for financial resilience. Let's explore how QQQE versus QQQ can help you achieve this balance. You may have heard of the Invesco QQQ Trust as a key featured index ETF on CNBC or other financial media, and its notoriety and performance has been raging on. But what about QQQE, the Direxion Nasdaq 100 Equal Weight ETF, and how key differences in this ETF can help you? You see, QQQE is a key ETF tool that can help you tackle portfolio overconcentration. Let's start by understanding these two investment tools. QQQ, or the Invesco QQQ Trust, is an ETF that tracks the Nasdaq 100 index. It's a popular choice among investors due to its exposure to the tech and growth sectors, and its method of allocation to each stock holding is what's called market cap weighted. QQQ's holdings are dominated by the Magnificent Seven, the tech giants Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and Tesla. In 2023, these companies have driven QQQ's outperformance, but represent near 40% of the ETF in 7 names, of $40 of every $100 invested. On the other hand, QQQE, or Direxion Nasdaq 100 Equal Weight ETF, tracks the same index, but with a twist. Instead of market cap weighting, QQQE uses equal weighting. Each of the 100 stocks in this ETF is approximately 1% each. This reduces the dominance of the Magnificent Seven, providing a broader exposure to the tech and growth sectors, with more balance to mid and small cap companies, and helps reduce overweighting to the mega cap names. So, why might you consider adding QQQE to your portfolio? The key reason is diversification. In today's market, portfolios are highly concentrated in the Magnificent Seven. While these companies have been performing exceptionally well, it's wise to hedge against the risk of their underperformance. By equally weighting each stock, QQQE offers a viable solution to this overconcentration issue. The equal weighting also has another benefit. It minimizes overlap with other core ETFs like VOO or Vanguard S&P 500 ETF. These S&P 500 or other growth ETFs also have a skew towards the Magnificent Seven. By investing in QQQE, you can ensure that your portfolio has a balanced exposure to a wide range of companies and less concentration risk. However, it's important to note that underweighting the Magnificent Seven could also mean missing out on potential gains if these stocks continue to outperform the market. But if the rest of the market participants make gains and the Magnificent Seven merely tread water, QQE could benefit from the broader expansion. If you've made it this far, consider giving us a like and subscribe to support our work of helping wise investors. We really appreciate it. While QQQ has its merits, QQQE's equal weighting provides a unique solution to the overconcentration issue, helping to balance your portfolio. Now that we've compared QQQ and QQQE, let's delve deeper into the benefits of QQQE for your portfolio. QQQE can be a crucial tool in your investing kit, especially if you're looking to balance your portfolio or tilt it away from these top 7 stocks. One key advantage is its potential to mitigate risk. In a world where the Magnificent Seven stocks dominate, having an over-concentrated portfolio can be a risk. If these stocks falter or simply tread water, the rest of your portfolio could suffer. But QQQE provides a counterbalance. By weighting each of the 100 stocks in this ETF to approximately 1% each, it intentionally tilts away from an excessive concentration in the Magnificent Seven. But what if the rest of the market begins to shine while the Magnificent Seven are treading water? while QQQE could benefit from this broader expansion. The equal weighting means your portfolio has a stake in a wider range of companies, providing an opportunity to reap rewards from a broader market upswing. Another major benefit is that QQQE can minimize overlap with other core ETFs you're likely exposed to, like VOO or other growth mutual funds, where fund managers lean into the same names. These investments also have a likely skew towards the Magnificent Seven, so QQQE can provide a more diverse exposure. The key is to be cognizant of your overall portfolio and consider an approach that, at times, lowers your exposure to the top names. QQQE offers an excellent strategy for this. The current market skew towards the Magnificent Seven is record-setting. It's important to think wisely about your ETFs and mutual funds. The equal weight ETF QQQE offers a smart choice for those seeking to balance their portfolio and mitigate risk. With each stock weighted at approximately 1%, QQQA reduces overconcentration and overlap with other core ETFs. It's time to review your portfolio and consider an equal weight solution like QQQE to bring your investments into balance. Remember, a balanced portfolio is not just a safe choice, it's a smart one.